Hello, I'm Makori. Thank you for joining us. Expect higher interest rates to be the norm for longer. That's the message from the highly anticipated Jackson Hole Central Bankers Summit. Federal Reserve Chair Jerome Powell confirmed his commitment to getting inflation to 2% and warned that additional interest rate increases may be needed to get there.
We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. 2% is and will remain our inflation target, but we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
Powell said that progress has been made in the Fed's fight against inflation and that the Fed will remain flexible as it contemplates further moves, but gave no indication at all that it is anywhere ready to start easing anytime soon. Now, interestingly enough, Powell's speech at the symposium in Wyoming did not once include the word dollar, whereas on the other side of the globe, at the BRICS summit in Johannesburg, the dollar was certainly in focus as leaders there pledged to continue to de-dollarize and to accelerate the move to use their own currencies for trade. The BRICS, Brazil, Russia, India, China, and South Africa, also expanded their alliance by inviting 6 more members to join the bloc. Argentina, Egypt, Ethiopia, Iran, the United Arab Emirates, and Saudi Arabia are set to become members from the 1st of January 2024. South Africa's President Cyril Ramaphosa said that now that consensus had been reached on the first phase of the expansion process, they will move forward to include even more countries in the next phase. So let's get some analysis on these developments, how they may impact the US economy, the dollar, crypto, and DeFi, and perhaps even the future of banking with Ken Olling. Ken is the founder and CEO of MELD. MELD is a non-custodial DeFi protocol for Web3 finance. It offers cross-chain lending, borrowing, staking, and integrated fiat banking services via MELD Finance on the MELD blockchain. Ken is a serial entrepreneur with more than 20 years of experience. He specializes in digital transformation and has delivered innovative products for companies around the globe, including GE, Audi, and Visa. Ken, good to have you with us. Welcome to Kitco.
Thanks, Michelle. I'm glad to be here.
Well, of course, we have been associated with MELD prior to you joining us for this interview. Full disclosure, MELD has been one of the sponsors of our content on Kitco. So very excited to now get the founder and CEO to give us some personal insight. And let's start off, Ken, with the macro and what we heard from the Fed. Jerome Powell sticking with that 2% inflation target, acknowledging that, they're feeling things out, seeing how their policy plays out in the real economy. And I'm quoting him here saying, doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. And then he also said, doing too much could also do unnecessary harm to the economy. And of course, that is the question that people are focused on. At what point does this policy do what he acknowledged could be unnecessary harm to the economy? So what is your main takeaway from what we heard from Powell?
I think his tone has changed a little bit since the last Fed meeting and the rate hike. He seems to be a lot more aggressive in his tone of voice about the potential of having another rate hike. He was a lot more passive in the last comments that he made. So I think that what they're probably seeing in the numbers is that their activities are not having the impact that they were hoping that they would have to the extent that they were going to have. So he's leaving the door open to be able to continue to have rate hikes and to make sure that those rate hikes are priced into the market now, as opposed to later on and sort of coming out of left field.
Okay, so he's trying to signal that there could be more rate hikes. I mean, the market, obviously not a big fan of that. We do have an expectation that we will see at least one more rate hike this year. That's pretty much baked in already, is what you're saying.
Yeah, I think that that's what he's trying to signal. He's trying to make sure that the current trend that's happening in the markets is going to continue to happen. He's not going to kind of he's not going to signal anything kind of out of the ordinary. What the markets want is they just want predictability, right? They want to know what's going to be happening. So as long as they have these key signals, then they'll be able to price them in, and they're not going to have this kind of flash situation where they have to react. And so I think that that's basically what he's trying to do. And I think it's partially in relationship to what happened at the BRICS as well. So I think that the feeling is that the U.S. is on better footing than it thought it might have been able to have been because of what happened at the BRICS.
Interesting. Okay, we will certainly circle back to the BRICS and how the central bankers in Wyoming were processing what came out of that meeting, which you're saying was potentially more positive for the dollar. But I still want to focus a little bit more on what we heard from Powell here. And it was interesting. You had a line there, Ken, and he said, as is often the case, we are navigating by the stars under cloudy skies. Very poetic, but not exactly very inspiring of confidence. I mean, what do you make of this? That we've got essentially the smartest people in the world of finance, as they're supposed to be, gathered at Jackson Hole, trying to figure out what to do with the economy, which of course impacts every single person's lives, and saying that we are navigating by the stars under cloudy skies. That doesn't really instill too much confidence.
Yeah, that's their kind of, I think that's their way of saying that don't have any, or you can skip your hopes for this idea of immaculate disinflation. That's not going to happen. So we're not in a situation where we can raise rates and maintain the economy's growth. There is going to be consequences along the way, and we don't know exactly what those consequences are going to be. I mean, really, we're in very, very uncharted waters right now. There's one way that it could go where, you know, the massive rate hikes that you saw in Japan in 1991 that collapsed the Japanese economy, that is a potential way of going forward. But at the same time, you're looking at US rates going up and Chinese rates going down. So we're seeing lots of reactions around the globe in ways that are not necessarily expected, and we don't know exactly how they're going to play out. All we can tell is right now, from an economic perspective, all of the economies around the world are going into some sort of contraction, recession, inflation as a result of the sort of COVID 3-year period, and we're having a difficult time understanding how things are going to play out, because each one of these actors are behaving in very, very different ways.
Right. So if the Fed does continue to tighten here, what is your outlook? How do you see the economy holding up with this higher for longer, assuming it's one more rate hike, as is the general consensus, possibly two, so maximum 50 basis points here, which again, the consensus is for another 25 basis points. How do you see the US economy handling that?
I'm not very optimistic that the U.S. economy is going to do very well. On one hand, you have all of the numbers and the KPIs you can work with, but there is a second side to this discussion. There's a second side to the understanding of the problem, which you're going to find more in TikTok than you're going to find on Wall Street. And if you look towards sort of common people and their reactions and their current kind of mental state, their mental state is more and more moving towards, we can't live. The mechanics that are governing our lives, our rent, our daily costs, our wages, they're all starting to become too distorted for a larger and larger part of the economy. And I think that this is really what is the most disturbing. And while I don't believe that it's a matter of like collapse or massive depression or something like that, I do think that there isn't a whole lot that the Fed can do to stop the reaction or the result of so much money being printed over the past 4 or 5 years. This quantitative easing, it's an experiment, and they don't really have any idea what kind of monster they're creating in the end. They're just hoping that they can control it on a year by year by year basis. I don't believe that they have this kind of really far-reaching long-term plan. They're trying to address the problem now in a very kind of reactionary manner.
And granted, I'm asking you to peer into your personal crystal ball here, but what do you think the likelihood is that they do have some kind of success in taming this monster that they've created, as you put it? Are you expecting a major recession? Are you expecting a major market fallout? And granted, pure asking you to forecast here a little bit, but what is your read?
Yeah, so I can say that before the end of the BRICS summit, I would say that my forecast was that we were going to go into a pretty severe recession in the beginning of 2024. We're going to see it sort of bottom out in relationship to property sort of contraction. And then we'll start to see liquidity come back into the space towards the very end or the very tail end of 2024. So that was my sort of forecast before the BRICS summit happened. Now I would say that it's a little bit different in the sense that I don't think that the recession is going to be quite as bad. And I think we're going to come out of it a little bit better than we had expected we're going to come out of it. And that's largely because you still see these potential counterweights as being very divided. And so the US still is going to be able to really kind of hold on to this idea of reserve currency across the world. And that's going to shore up a lot of, it's going to give it a lot, it's going to maintain a lot of the tools that it currently uses in order to have this hegemony. And so I think that we're in for a recession in 2024, but probably not quite as bad as if we were going to see a potential competitive currency coming out of the BRICS to challenge the dollar. The dollar is going to stay the sort of leading currency for the foreseeable future now. And so I think that it's not in good shape, but it's definitely, the better among the worse.
So interesting. You're saying that you see the development out of the BRIC as a positive for the near term strength of the US dollar and the US economy. Why is that? I mean, we did have another 6 countries effectively invited to join this bloc and expanded in a very significant way. Why do you see this as a positive for the dollar in the near term?
2 main things. So the BRICS had the potential or have the potential to be a counterweight from a currency perspective, from a reserve currency perspective, and from an institutional perspective, a counterweight to the World Bank, the IMF, the UN, this kind of thing. The BRICS Bank is still very young. Their mandate is still very narrow. They've been clear that they're not going to do any direct investment themselves. So they're going to do partner investment. And when the Brazilian president brought up the idea of a currency, it was struck down by India very quickly.
Okay, so you're saying that this has perhaps bought the US some time, because going into the summit, the idea that we would discuss or have that there would be any kind of formal discussion about this common currency coming from the bloc was put on hold. Going into the summit, there was a confirmation from the South African ambassador that they weren't going to talk about the currency at this particular summit. That seems to be very much on the agenda for the next summit, and this will now be with a bloc that is considerably bigger, assuming these countries that have been invited to join do in fact accept that membership, which looks like they will come January of next year. So there wasn't that much real expectation that we would see a currency emerge from this particular summit, yet you still see that as a positive.
Well, there was a lot of statements saying that they wanted to encourage each of the BRICS members to use their own currency for trade, right? So it was very much in the opposite direction. It was in the direction of fragmentation as opposed to centralization.
But still moving away from the dollar. That was still a predominant theme. Granted, I hear your point that in terms of coming up with a singular viable alternative in the form of some potential commodity-backed currency, as the speculation leading up to the summit suggested would be the result of this, and then was subsequently no longer on the agenda. I hear your point that isn't happening, but there still is very much this agenda to push away from the dollar at large and have trade happening with their own currencies.
And it will, it's kind of what I would see it as de-dollarization in a way that is most friendly to the dollar, right? So if you have a situation where you have 8 different countries and they're all trading in their own currency, they all have control over their own monetary policy. Many of them are known for having very loose monetary policy. When one of them decides to print more money into the market, and then that expansion of the money supply then gets taken into the FX markets, and it sort of debases that asset. And then you start running into these kind of problems between the trade. Basically, you run into the same problems that you ran into before the dollar was the reserve currency. So you get this sense of mistrust. You get this difficulty in regards to doing these trade situations. Granted, the BRICS Bank has negotiated a set of swap terms between all of the member state banks. So that is one definite positive. But I still think that had they come together and not necessarily done something about a single currency, but had some strong statement toward it, it would have been a very, very strong message to the global South that there was sort of this thing that they could sort of hold on to. Instead, they said everybody is going to go do their own thing, which is very contradictory to what you see in the G7, right? In the G7, you've got the dollar, you've got the euro, you have this idea of coming together under a single currency and sort of negotiating as a group as opposed to negotiating piece by piece.
But this is for now, Ken. This is we're going to continue this trend to move away from the dollar and continue to trade in our own currencies for now. As the bloc expands, adding more members, gaining more clout, gaining further representation of global GDP, further representation of global commodity supply chain control, population numbers, then as a bigger unit, potentially look at this new currency, this global reserve currency that brings about unity. So my point is that, is this really a positive, or is it just buying the US a little bit of time as they further get their ducks in a row, potentially?
I think in one way it is buying the US a lot of time, but I don't have that much faith that if you're talking about a large international organization, the ability to add more members equals your ability to make more decisive decisions.
Okay.
And so I think as they add more members, especially since they have several members now that have very close ties to the United States and very antagonistic ties to the United States, then it's going to become a bit more politicized than it was as just the sort of the core BRICS. So I think that, yes, they're probably going to move in that direction, but is it going to become a lot slower because you have more participants? Yes. And as they add more participants, it will become even slower and slower, is what my expectations are.
I mean, that is a valid point. When you have more members, it's harder to reach consensus. And just with the original BRICS, there was already some issues, as you mentioned, with India and China not necessarily being on the same page with regards to the global reserve currency, not even necessarily being on the same page with regards to adding these new members. So more members will make it potentially harder to reach some kind of agreement. So I do see that point. And yes, you've got countries that still want to maintain a favorable relationship with the US, like India, for example. And now you've thrown Iran into the mix, which we know has terrible relations with the United States and the West. So you're saying that the expansion, in a way, is diminishing the threat that this bloc could pose towards the dollar.
Very much so. Very much so. Had they come out and said, we are planning a single currency for all of our members to trade with in the same way that the World Bank and the IMF, they demand and they trade in dollars and to a lesser extent in euros, that would have been such a powerful message to all of the global South as a way to kind of rally behind it. Now they have to say, okay, do we trust in do we trust in our own currency? Do we trust in Chinese currency? Do we trust in Brazilian? What currency are we going to use in this particular situation? And it becomes a lot more complex, a lot more of a slippery slope. As soon as they touch any of the G7 or the G14, machine, then they're going to request either euros or dollars. So no, I think that they missed a massive opportunity to point their sort of compass in a specific direction. And yeah, from my perspective, it's going to be very, very slow going for the BRICS. I do believe there is obviously de-dollarization, but not in the same way as I had imagined if they would have announced something. Now, I think the big winner here is not the dollar and it's not the BRICS, but it's crypto.
Interesting. And we will certainly get to crypto. So, Ken, just to summarize, you're saying had the BRICS maintained their group as this nucleus of 6 countries, maybe added another rest, maybe added Saudi Arabia and focused on the currency instead of expansion, you think that that would have been a bigger threat to the dollar than this current expansion that we're seeing now?
Absolutely. And, this is all set in the backdrop of the US and Europe seizing the dollar-denominated reserves of Russia when Russia invaded Ukraine, right? So that activity, that seizure, put a scare on central banks all over the world. Were their dollar-denominated reserves safe, right? Especially in regards to China. So I think that specific action is what gave the BRICS their momentum. So everybody in the world, all of the global south and in the north, started to say, hang on a second, are our reserves safe if we don't agree with the United States? Can our reserves be seized as well? So I think that was their sort of fuel into this summit. And the fact that the output was just simply, we're a bigger group of people, not that there's this more sort of rallying cry around either a currency or more institutions, is kind of they missed an opportunity, I think.
But there is a rallying cry against moving away from the dollar exactly in response to the point that you made of the weaponization of the dollar following Russia's invasion of Ukraine and the response that the US and its allies took regarding Moscow's actions there. So the rallying cry has been, don't trade in the dollar, move away from the dollar. But you're saying they missed the opportunity to go ahead with the currency. But we still now have the idea of several of the world's leading oil producers as part of this expanded group, right? We've got,
absolutely,
of course, we've got Russia, we've got the United Arab Emirates, we've got Iran, we've got Saudi Arabia, assuming they join as well, as they've been invited to, but they still haven't given a definitive answer as yet. I mean, we've got, I believe, 42% of the world's oil producers under one umbrella, and we do know that the dollar's strength hinges on the idea of the petrodollar, which was the agreement that the Nixon administration made with the Saudis in the 1970s after they took the dollar off the gold standard. So is that not a concern for you, that together as a group, they actively continue to move away from pricing oil in dollars and in other currencies, and that in itself could represent a big attack on the dollar, especially considering that we do now have a bigger group here?
Yeah, I mean, it will definitely undermine the dollar to some degree, but it's not going to prove to be the answer to the dollar, which is what a lot of people were seeing the summit or seeing the BRICS as being an opportunity to do. So people are looking for an answer to the dollar. They're not looking for the answer to be a lot of different things depending on your attitude or your opinion or your political sort of disposition. So where they were in there was a cry, there was an appetite in the global economy for something that could compete. And the result of this was that, they weren't ready to commit to something that bold just yet.
Interesting. Right. Again, could say that is still happening, could still develop, especially with more members. But your point is more members makes it more difficult to get some kind of consensus. Yeah, more
slow going, I think.
Interesting. A very interesting perspective there, Ken. So, while this was happening, as we said, we had the Jackson Hole Symposium, and many people were wanting to see if there was going to be any kind of acknowledgement of what was happening in South Africa from the central bankers gathered there. We didn't hear anything from Powell about this. Christine Lagarde did make some comment, some vague comment, didn't mention the BRICS specifically, but she did have this to say, and I'm quoting here, We're facing a deepening geopolitical divide and a global economy that is fragmenting into competing blocs. This is being accompanied by rising levels of protectionism as countries reconfigure their supply chains to align with new strategic goals. Over the past decade, the number of trade restrictions in place has increased tenfold, while industrial policies aimed at reshoring and friendshoring strategic industries are now multiplying. And while this has not yet led to deglobalization, evidence of changing trade patterns is mounting. What's your read on her comments there?
Yeah, I think that's absolutely a byproduct of first COVID and the awareness that happened when it came to supply chains breaking down. Then the war in the Ukraine, when you had this energy crisis in Europe, and now this idea that the BRICS are going to be able to sort of create a counterweight against the G7. So I think this is a byproduct of those three major trends. I think that it's just a matter of them stating the fact that they're very, very aware that these things are going to happen or that are happening. And they are putting policies in place to make sure that they can minimize America's sort of a negative impact on the U.S. when these things or how these things happen. I mean, the U.S. has been the sort of center of global trade, and they have the institutions to be able to protect this. So they have the infrastructure, they have the assets, they have everything that they need to be able to play in this space, and they're going to play very, very hard. So I think that it's a kind of a bullish statement saying that they're aware of these things and they're up for the challenge. The U.S. is still going to push, still going to be a powerhouse, and not to count them out, especially when it comes to global trade.
Do you think that behind closed doors, the tone taken about this BRICS expansion is different?
Yeah, if I would guess that, going in, you saw the statements that were sort of the answer to the Brazilian president about the BRICS currency, and them saying that, no, it is not going to be discussed. I think that they were just elated by this sort of response. And so internally, they could stop focusing on sort of having to deal with this kind of external or existential dollar crisis. And they could focus on, the US economy. They could focus on how to better handle their trade relations and how to build and shore up existing trade relations. So I think that all in all, it was a good day for the people at Jackson Hole. When it came to international geopolitics and economics. But now they have to focus on what's happening in the US, which is an infinitely more complex and problematic thing to address.
Well, it makes it even more problematic and more complex when you do have a viable threat to the dollar. But as you've just explained your position, they failed to seize on the momentum there. And the expansion of the bloc makes that less likely to be a realistic probability in the near future. So let's talk about what these developments then mean for crypto, and particularly for MELD, because you've said that these developments of moving away from the dollar, which we are still seeing the de-dollarization trend, regardless of there being a viable alternative to the currency or not, has been a positive growth driver for MELD. Let's break that down. What do you mean by that?
Yeah, so I mean, as you see the world, and as you see countries and people understanding monetary policy better, as you see people understanding what the word quantitative easing means, they become much more aware of how money supply works, and they want to have an alternative towards that. So you've seen this in the amount of people that hold cryptocurrency, and I think that over time, you're going to see this more and more in business as well. So the fact that the BRICS didn't accept the current or to come up with a new alternative currency means that Bitcoin now has a much, much bigger potential. And so when you're looking at this from a global perspective, not from a national perspective, not from a sovereign perspective, the idea of keeping your assets on chain is very, very attractive. They're controlled by you and you exclusively. You don't have to worry about external forces coming in and doing something with it. You don't have to worry about your government printing money. You can get access to all of the upsides that economies offer and also have more protection against the downsides. So, for example, today you can actually keep your stable coins on chain and you can get access to T-bills. So you can get access to 5% yield on your US dollar when it's on chain. But when you look at that potential offering in the United States and in other countries, the yield you're going to get is going to be negligible. It's going to be sub 0.1%. And so I think that there is a degree of freedom that the blockchain offers, and that freedom affords you more financial mobility. And that's what people are starting to understand as they understand monetary policy better.
All right. But you're also saying that the bifurcation of the global monetary system is a positive growth driver for MELD and cryptocurrencies. Is that because, as you've just said, it creates room for other alternatives like Bitcoin, like other currencies?
You've had fashion in the go-to sort of reserve currency. So if the dollar's going down up until maybe 10 years ago, you would go into the yen, right? If the yen was going down and the dollars were going down, then you'd go into gold, right? So you had all these opportunities to go into these different reserve currencies. Now, none of them are looking very good. So the dollar's not looking good, euro's not looking good, RMB's not looking good, the yen's not looking good. Where are you going to go? So this idea that Bitcoin is finite, this idea that some cryptocurrencies are completely finite, you know exactly how they're going to behave, is really attractive. It took me years to figure this out. I thought it was funny money when I started out. But when I finally realized, this is something that I don't care if you're the president of the United States or you're the premier of China, you can't change it. That's a huge, powerful idea, but it only comes to people that have been affected by negative monetary policy.
Which is everyone, quite frankly, right? When you have central banks continue to just print or mouse click their way into creating more and more money, everybody sees their currency debased and devalued. And of course, you're referring, I guess, to Bitcoin, which has a finite supply. Only 21 million Bitcoin can ever be created. But that doesn't apply to other cryptocurrencies. I mean, that's one of the biggest strength of Bitcoin, as the Bitcoin maxis will tell you loud and clear.
Absolutely. Yeah. So, I mean, crypto represents kind of financial creativity in its kind of most perfect form, right? And that comes in silly things, and it comes in scams, and it comes in wonderfully successful and powerful financial tools, all of them together. It's the whole sort of landscape. But it's a period right now in crypto where everybody is experimenting, trying to figure out the most effective way to reproduce the financial landscape in a non-custodial, in a sort of a decentralized way where no one single individual, no one single actor has direct control. And so I think that Bitcoin represents this kind of pure truth in crypto, the simplest, and then you have all these variations. But there are also a lot of other cryptocurrencies out there that use Bitcoin as their kind of reference, as their model, and they have the exact same set of principles. The MELD token is one. We have 4 billion tokens, and it's fixed. There's never going to be any more or any less. It's something that you can count on. And I think that when it comes to a currency, that is something that is really undervalued, is this idea of being able to count on something being there.
Right. And being able to count on that something being at that fixed supply and not changing, as we just discussed, is very critical here. Well, help our viewers understand what MELD is, because you mentioned the MELD token, and that's just one facet and aspect of MELD. I know that MELD is a decentralized, non-custodial liquidity protocol that allows users to borrow fiat against their crypto assets and then earn a yield on their deposits. Explain in the simplest terms what that actually means.
Yeah. So in the simplest terms, the blockchain is the place where you store your assets, whether it's cryptocurrency or stablecoins. They sit on the blockchain and they can only be accessed by you. So you're the only person that has control over those. When you want to do something with them, then you can either take those assets and use them in the world of crypto. You can generate a yield. You can sort of stake them, put them into a savings account. And at the same time, if you need them in the fiat world, then they will be instantly moved into your debit card, or they'll be instantly sent as a wire transfer to pay your rent or buy a car or whatever you're trying to do. So, but the home, the place where they live, is on the blockchain. And it's secure. Blockchains have never been hacked before. So they're safe, they're predictable, they're manageable. And then you're able to sort of have this foundation, this starting point, this bank that you can then go and use your assets in various different ways. So simplest terms, your bank is on the blockchain, your bank account is on the blockchain, and you use it wherever and whenever you want to based on your goals and your efforts.
All right. And of course, you're holding your keys, so you're controlling your actual cryptocurrencies. Now, Ken, one of the distinct features of MELD is that it allows you to unlock the value of your crypto without liquidating your position. So explain what that means. Let's say I have 2 Bitcoins. How do I unlock the value of my Bitcoin without liquidating my position? What does that mean?
So this is actually one of the oldest forms of banking in the world. It's called Lombard financing. In Europe, there are a lot of streets in the major capitals called Lombard Street. That's because those were the streets where the banks were at. And effectively what it means is you have something. In the old days, it was property. And then the banks allowed you to borrow against that property. So today, what we're talking about is cryptocurrency. So if you have 2 Bitcoin, then you can take those Bitcoin, you still own them, they're still on the blockchain, and you put them into a smart contract and you say, I want to use these 2 Bitcoin as collateral. What happens then is because you've used them as collateral, you get interest on them. You get a yield from them. We haven't even borrowed anything yet. You've just supplied them as collateral. You're now generating an income from that. Then, because they're as collateral, you can borrow fiat against that. So you can borrow up to half the value of Bitcoin. You borrow that in fiat and off you go. Remember, you're paying, let's say you have 2 Bitcoin, you're getting 2 Bitcoin worth of yield by supplying that, but you've borrowed 1 Bitcoin in dollars. So you're paying interest on 1 Bitcoin in dollars. So you're paying interest on half of what you're getting a yield on. So in most cases, the difference between those is going to be close to zero. So you're going to end up with actually having a net neutral interest rate, and you'll be able to get that fiat. So you get the fiat, you can do whatever you want with it. You've borrowed it. You haven't sold your Bitcoin, so you haven't incurred a tax event. So you don't have to pay tax on that because you still own it. You've only created debt. If you want to pay that back, you can, but you don't have to, right? Over time, Bitcoin will continue to go up. The value of the dollar is going to stay here, but the value of Bitcoin is going to keep on going up. So the percentage of the Bitcoin that you have in dollars is going to keep on going down. So this is very old-fashioned banking. This is what a lot of corporations do. This is what a lot of high net worth individuals do. We want to make this very powerful tool available to anybody. You don't have to have 2 Bitcoin. You can have a quarter of a Bitcoin and borrow a little bit against that if you need to.
Okay, a lot to unpack there. Firstly, where is the fiat coming from in the scenario, right? Who is actually giving me the fiat in exchange for me supplying my Bitcoin as collateral?
So somebody else has supplied fiat into this and said that I want to put my fiat in here and I want to get a yield from it.
So that's not coming from MELD. MELD is the facilitator here. MELD is the platform that allows these parties to come together through a smart contract.
Yes.
Okay, go on.
So the idea here is that in traditional financing, all of these activities are done by a bank. So in the traditional world, you come to the bank with your collateral, the bank takes the collateral, and the bank makes the yield on that collateral. Then you have to pay that loan back. You pay that interest back to the bank, and the bank gets that interest. What we've done is we've broken this into pieces, and we've said that instead of having this centralized entity doing this, you have everybody doing it. So I'm going to supply the collateral that other people will use, and I'm going to borrow against that. So you can be both sides, you can be both parties. So you benefit from the supplying, which is effectively a savings account, and you can borrow against that, which is effectively a loan against your collateral.
Okay, and how does MELD make money then? Because in the traditional banking world, the bank makes money. How does MELD, the platform, then make money, which I guess translates into value for the MELD token? But what is your business model here then?
Yeah, so we make money when our customers make money. So when our customers deposit and they get a yield, we get a small percentage of that. When somebody borrows the money and pays interest, we get a small percentage of that. So we only make money when the platform is being used, when the network is being used. The more people that use it, the more money that our customers make, the more money we make. So there's a direct correlation between the use of the platform and how much money we can make, or the profit of the users and how much money we can make.
Okay. Now, when you were describing the scenario, you said that as the value of my Bitcoin goes up, the scenario develops where I am able to get more yield and in fiat form, right?
Yeah.
But what happens if my Bitcoin doesn't go up, right? I guess, I mean, we're hoping that the long-term picture for Bitcoin is to go up, but what happens if it doesn't?
Yeah. So each of the assets have a different risk profile. Bitcoin, as an example, is about 50%. So you've set it up so that you have this much Bitcoin and you have this much in dollars that you've borrowed out of it. When the value of Bitcoin against the dollar goes down, when it gets to a certain level just above the value of the dollar, then that position is liquidated. And what that means is that another person in the space, not us, but some other people in the ecosystem, are liquidating that position. And when they liquidate it, what that means is they pay your loan back, and then they get those 2 Bitcoin. So if you don't pay some of the loan back, or if you don't add more Bitcoin, if you do those 2 things, then you're fine. But if you don't either pay the loan back or put more Bitcoin in there to sort of increase the collateral, then somebody can liquidate it. And if they liquidate it, then, like I said, they pay the loan back and then they get the Bitcoin. But you have not defaulted. There is no such thing. There's no concept of default in a Lombard financing system. You simply have your position closed out. You have the fiat that you've borrowed. You keep it. Your loan has been paid back, and you don't have the Bitcoin anymore. The Bitcoin has been sold to the person who paid your loan back.
And explain how a smart contract makes all of this so clear, so efficient, so indisputable.
So smart contracts are interesting. They're neither smart nor contracts. The best way I can describe a smart contract is it's a bank account. So it's a piece of software that is a bank account that holds money in it, that has logic connected to it. So you put your Bitcoin in there, and then the logic says, okay, this Bitcoin is locked until the loan is paid back. When the loan is paid back into that smart contract, then the Bitcoin is unlocked and you have your Bitcoin accessible to you again. Remember, all this is still sitting on the blockchain. It's never left the blockchain. So all it's saying, it's not saying that it's taken your Bitcoin. All it says is it's locked up your Bitcoin until these criteria have been met. Mm-hmm. And so the smart contract itself is just a set of rules that tell the blockchain how to move that asset around, or how to lock it up, or how to free it up, or how to send it from one place to another. And so it's really, it is very akin to a bank account in many different ways. The thing about it is that It's not controlled by anybody. So I can't go, we run the protocol. We don't have access to these smart contracts. We don't have access to be able to do anything with your assets on the blockchain. The only thing that can happen is you either pay your loan back or it gets liquidated. Those are the only two possible ways that those Bitcoin can be released.
Right, and it's pre-programmed in the contract. So, and this happens if this condition is met. This happens if this condition is not met. So going into it, you have the parameters that trigger depending on how things play out. Now, Ken, you mentioned various risk profiles and saying that Bitcoin considered a more stable asset, so a less riskier asset. Give us another example quickly of how this happens with, say, a more volatile, higher risk profile cryptocurrency.
Let's use Dogecoin. We love Dogecoin. Right?
Let's use Doge.
Let's use Dogecoin. So Dogecoin is a good example. So Dogecoin is very, very volatile. It has a supply. It's very unlike Bitcoin in the sense that its supply goes up every year by a huge amount. So its risk profile is much higher. So if you have a lot of Dogecoin, then you'd only be able to borrow maybe 20 or 25% of the value of that asset. And then that's going to be the sort of the limit. And then if Dogecoin sort of fluctuates, which it does a lot, if it fluctuates massively, like, 60, 70% down, then that position is going to be liquidated. But each currency is going to have a different characteristic. The two safest cryptocurrencies are Ethereum and Bitcoin, obviously. But to give an example, if you have a stable coin like a USDC or USDT, then you can borrow 90% of the value because you're locking up this stable coin and you're borrowing fiat against it, but it's the same. So usually it's the same. So when the dollar goes down or goes up, then USDT is going to go down and go up. So they'll go up the same. And so it's a lot. You can access much more of the liquidity out of that than you can for assets that are much more volatile.
Right. Now, one of the key factors to understand here is that when it comes to MELD, you're non-custodial on both sides of the equation, correct? So,
kind of, yes.
Okay, so explain that, because you're neither supplying the fiat and you're neither holding or taking possession of the crypto.
Yeah. So effectively what we're doing is we're the market in the middle. So we build technology that makes it safe for people to supply their asset, which is kind of equivalent to a savings account, and then they can generate a yield from that. And at that same pool of assets, you can borrow from. So that is on the crypto side. The non-custodial part comes in when you're talking about your account that you have access to your assets on, where you can buy and sell and trade on. That account, the only person that has access to that account is you. You're the only one that ever has access to it. We don't have the keys. We don't have any way of doing anything with it. If anybody comes to us and asks us to give access to it for any reason, we can't, because we simply don't have it. But that's on the crypto side. Then on the fiat side, we don't have a formal banking license in the traditional sense where you take deposits and then you're allowed to lend that money out again. We have a license that is connected to an electronic money institution. And so that electronic money institution, it can facilitate transactions. So we will be able to take deposits. Those deposits, though, are held by the central bank. So we're only a facilitator in being able to move money around. We can't actually do anything with it. So that's what I mean by non-custodial, in the sense that, yes, when you're providing a deposit to us, we're getting the transaction into our account. But at the end of the day, that asset, the dollar or euro or yen or whatever it is going into the central bank and being held by the central bank.
Which central bank?
Lithuanian central bank.
Right, because you are registered in Lithuania.
We're in the process of being registered in Lithuania, yes.
So it goes back to the Lithuanian central bank, not some intermediary, some local bank that you're working with, direct to the central bank of Lithuania.
Only to the central bank, correct.
Why Lithuania?
And we like this. Why Lithuania? Lithuania has been a very sort of forward-looking jurisdiction for fintechs for the past 10 years. Their central bank is very, very modern. They're neither pro nor anti-crypto. They're focused on treating crypto in a similar manner to the way that they treat other fintech businesses that deal with, debit cards or lending or wire transfers or things like that. So we wanted to be in a jurisdiction where the regulators were very even-handed and very focused on good policies and not having too politicized view on pro or negative crypto. So jurisdictions that are very pro-crypto, they tend to have very lax regulations, and they get caught in very difficult situations. And then when you have, very hostile, like the United States, then it makes it just very, very expensive and difficult to do much of anything. So
Lithuania is like the Goldilocks, the sweet spot of not too hot, not too cold. Which jurisdiction is very favorable, perhaps too favorable, too lenient?
I would probably say right now it's the Seychelles, maybe Panama, these kinds of offshore jurisdictions. And then on the other end of the spectrum, you have the United States and China and India, which are still very, very hostile to crypto. And then you have countries like Estonia, which was very lenient for a period of time. And then they realized that they were too lenient, and then they became very, very strict. So it's a matter of what your kind of time horizon is for what you're doing. We're in it for the long run. We're focusing on building very good relationships and these kind of long-term systems or very well-built systems that can really kind of stand the test of time and do business the right way, not try and just, get rich quick and solve a problem right now at the expense of, whatever.
Right. Well, and of course, regulation is still being worked out around the globe. But this whole idea of yield and new age banks and promising great returns and promising to be able to take independence of your money. I mean, we've heard this before, Ken, and it didn't work out so well, especially with lax regulations, right? I mean, we've had the likes of Celsius, like FTX, like Voyager, making some very, very enticing promises, and not delivering would be an understatement. Now, some by design, some perhaps not by design, but through mismanagement, miscalculations. Either way, people lost a lot of money. And,
so let's
and the specifics are different from Celsius to FTX to Voyager. But let's unpack that, and more importantly, why is MELD different then?
So let's just be very, very clear about this. So Celsius provided lending and borrowing similar to what we're doing. So did BlockFi. Celsius and BlockFi had 50 licenses in the United States. They were highly regulated. They were fully licensed in the United States. Okay, so they weren't operating outside of the entire system. They had an army of lawyers internal to make sure that they met sort of every iota of compliance and requirements that they were able to meet in the US. The fact that they got fast and loose in how they handled their lending and borrowing and what sort of yields they went after, that's a mismanagement internally. Mismanagement happens in financial industry, financial companies, as well as in crypto companies. But the thing that's interesting is if you look at the DeFi counter to Celsius, which is Aave, there's no defaults. There's no mismanagement. There's no abuse of funds. There's none of these things. So yes, centralized finance using traditional licenses under regulated jurisdictions, they massively abused their power, and they were able to use those licenses and put them in front of customers and tell them that they were, trustworthy and insured and all this kind of stuff. And everybody believed it. And then you have these DeFi protocols that are saying, look, everything that we do is on chain. We get audited every single day by hundreds of our customers. Everybody is looking at our transactions under a microscope every minute of every day. That is a so much healthier way to operate when you're dealing with finance than to wait for 1.5 years and then hire somebody to audit your books. So if you want to understand where things went wrong versus where things are working, if you look at FTX is a good example. FTX was highly regulated. They were very, very close to the US government, to the Fed, to the SEC. They worked closely with them. They were on Capitol Hill all the time. The counterpart to FTX, Uniswap is doing fine. Their business is very successful. Everything is on chain. Everybody can see their transactions. They can't abuse their money. They can't take people's funds and go do stuff with it. So when you have your assets on chain, it means you're constantly being audited. It's under a microscope all the time. And that is super, super healthy for the ecosystem as a whole.
So you're saying that the assets of Celsius and FTX were not on chain, and that's the big difference between
it was in
MELD.
A black box, right? It came off chain. They took the assets off chain. They put them into custodial environments. They put them onto centralized exchanges. They were able to do all kinds of things with them that they shouldn't have been able to do with. They weren't really allowed to or supposed to do with them. But the fact that they basically went into a black box, which was this centralized solution, this kind of pseudo blockchain system, that's where the problems started to happen. And when you do that and you see the big potential sort of upsides of lending money out unsecured and getting huge yield on it, then you're playing into the reason why Bitcoin was created. Bitcoin took human sort of greed at face value and said, if it's on chain and it can't be manipulated, then somebody can't get greedy. And that's really what we're trying to do. We're trying to embrace how humans are. We're not trying to fix them. We're trying to make a system that can work in parallel to them. Acknowledge
the flaws and weakness that are involved with being a human and play accordingly. Okay, so Ken, what are the risks then with your platform? Right? What can go wrong for me? Yeah. What should I be aware of?
The biggest risk in the space, well, there's two of the biggest risks in the space. One is being socially hacked. So somebody sort of getting a hold of your keys by some sort of method of contacting you, pretending that they're support for MELD or somebody else, or how there's 100 different ways people can sort of reach out and try to socially get a hold of your assets. So that's the first part. And the second part is smart contract risk. So smart contract are programs that are written by people, and those programs can fail. And those programs have failed absolutely spectacularly in the past. So security is the absolute most critical part of it, and having as few moving parts as you can, as well as having some key elements in there. So something like, sorry, I'm losing my voice. Something like having a pause button, right? So you have this in major markets. You have this circuit breaker clause in major markets now, right? This is a rather modern sort of invention in the markets. And so you have these same sort of things that can happen in protocols. And we're sort of taking those ideas from the traditional markets and bringing them into ours. So if something goes wrong, you can push the pause button, everything stops working, and then you're able to kind of address whatever the problem may be.
Could that then nullify the whole idea of a smart contract if you can pause it?
You can't pause it and do something to it, right? You can't pause it and then take some money out or do something, all you can do is pause it, right? So for example—
But for how long? Like if somebody owes me money and they haven't paid their money, and the smart contract is supposed to ensure that I get my fiat in exchange for lending out my crypto, for example, and I've now paused the contract somehow, I could be sitting there waiting for them to pay up for how long?
Yeah. So typically when hacks happen, they happen in very, very short periods of time, maybe 3-4 hours tops. Mm-hmm. So what you want to be able to do is you want to be able to hit the pause button, and you want to be able to stop that hacker from doing whatever they're currently doing, and then either make some sort of adjustment or find that hacker and stop them from sort of mitigate whatever it is they're trying to do, and then unpause it. So there needs to be that, well, it doesn't need to be that kind of thing. It depends on how much of a purist you are. But in our perspective, the ability to be able to pause it is a huge risk mitigation. And you've seen this, it just happened a couple of weeks ago in a big exchange, a decentralized exchange called Curve, where there was a fault in one of the smart contracts that was not the fault of Curve at all. But it created a problem, and they lost a bunch of money. They didn't have the ability to pause it. So had they been able to pause it, they could have stopped that process from happening, and then they would have been able to go and mitigate it. They still would have lost something, but they could have lost less. So there's several different types of security mitigation techniques you can use. You have audits. All of our contracts get audited by security analysts and things like that. The other side of it is that we have insurance. So one part of the protocol is for lending and borrowing, and another part is insurance, where the community can supply assets as insurance. They get a yield, they get a premium for supplying for that insurance. And if that insurance is needed, then that pool can be used to make the thing whole again.
Okay. So in one sentence or two, the pros of using this particular aspect of MELD versus the cons.
You're able to take control of your money and generate an income from yield and use fiat and crypto whenever and wherever you want.
And the cons, you could get hacked potentially. The smart contract could be compromised. What could be the worst case scenario for me here?
The worst case scenario is that you personally are hacked. Somebody gets a hold of your keys, and then they're able to take your assets from you. It's the equivalent.
That's less to do with MELD per se than somebody hacking me on another exchange or my hot wallet.
That's the most common problem. So it happens almost on a daily basis. So I can't tell you how many times, if we're looking at our customer base, we might have had 200 or 300 people in the past year that have been socially hacked, that they've had their keys taken from them for whatever reason. Somebody misrepresented them or something like that. Somebody installed the wrong software, some sort of software onto someone's Android phone, and then they were hacked. So the biggest risk is social hacking.
Right. Now, Ken, we're running short of time now, but I realize that this is just sort of one branch of what MELD offers, correct? This is just one aspect of the bigger MELD picture.
So this is the center, the core, the banking services, the ability to handle your own money. And then there's elements on the outside of it.
All right. And we will have to have you back to discuss those elements, including helping our viewers understand more about staking, more specifics about yield, and of course, more about the MELD token itself. But we're going to have to leave it there for now. Before we do, just so we're clear, what of this is available for viewers in the US and in Canada?
So our service, our fiat services are not available to U.S. citizens. Canada, yes. So if you want to sign up, you're able to go to meld.fi/sign up, and you can sign up for early access. We'll be coming out towards the end of this year. When it comes to all the crypto services, those are available to anybody anywhere in the world.
All right. And again, full disclosure to our viewers, MELD has been a sponsor of some of our content, but we vet our sponsors very, very carefully. And we will continue to vet you via an interview on the spot next time, Ken, to discuss some more of the product lines as well, and also get your thoughts, again, on the crypto space at large, as well as on the macro economy. We're out of time for today, but thank you so much for joining us. Appreciate it so much, Ken Olling.
Thanks, Michelle. Talk to you later.
All right, thank you. And as always, thank you so much to our viewers for watching. From me, Michelle Makori, and the rest of the Kitco team, we'll see you soon.